In this week's video, we'll review the latest charts, studies, and data sets to help us answer the question, are global stocks breaking out? We've got a lot to cover, so feel free to use the pause button on your video player. On December 28th of last year, the Nasdaq printed a new closing low for the bear market. And soon thereafter, a tweet from January 4th, we started to see some significant improvement, including some favorable risk-reward setups in foreign markets. It's now 3 weeks later, so let's take a look at market breadth to see what we can learn. It's a very volatile breadth indicator based on advancing and declining stocks. See, it's rare to get a reading this low. This is Q4 of last year. This is Q4 of 2008. And if we look at the data going back to 1982, it's only happened 4 previous times, 1987, 1990, 1998, and in Q4 of 2008. And in each one of the historical cases, really good things happen in the S&P 500 index looking out 1 year, 2 years, and 3 years. Similar situation here, S&P 500 stocks greater than their 200-day simple moving average. It's rare to be way down here and then make it all the way back to the green line. It's only happened a handful of times dating back to 2002, and we're looking at all of the data that we have. In the 5 previous cases, the S&P 500 was higher 80% of the time, 1 year out, 2 years out, 3 years out, 4 years out, and 5 years out where we have data. 100% of the cases the market was higher, and you can see in some cases substantially higher. The studies tell us we should remain open to better than expected outcomes. We still have to trade the chart in front of us. And ultimately, the charts in front of us and the data that we have in front of us either has to align with or it will contradict expectations based on the historical cases. Dow Advanced Decline line, January 26th, as we covered last week, this looks better than anything that we've seen dating all the way back to January of 2022. Similar situation, S&P 500 Advanced Decline volume weekly. See this turn here, we go down, come down here, there's a lot of white space between the indicator and the lower Bollinger Band, and then we come back up. That really looks better than anything that we've seen dating all the way back to Q4 of last year. This is Dow new highs minus new lows. You can see back here near the COVID low. Common sense tells us that if the market or index is going to rally, for the most part, new highs minus new lows eventually has to turn positive. And once again, the look of this indicator or data set looks better than anything that we've seen dating back to, let's say, January of 2022. And we mentioned that the Nasdaq made a new closing low for the bear market as recently as December 28th. So this is the Nasdaq here. This is price. This is November of 2021 here. This is the present day here. Got a very favorable breadth divergence here. This is Nasdaq new highs minus new lows. That data set has been improving since May of last year. And recent readings are better than anything that we've seen. We have to go all the way back to Q4 of 2021. Simply telling us to keep an open mind about better than expected outcomes. If we look at this same data set in a different form, and we've covered this many times, this is the major low in 2003, major low in 2009, 2010, 2011, etc. You can see we're trying to turn up here. This too looks a little bit different in a very subtle way than all of this back here into Q4 of 2021. If you follow along on Twitter, you may remember we've shown some of these boxes and we've said if the low is going to be successful, this type of data set needs to get in to this portion of the green box. This is the major low in 2009. Until recently, we really hadn't done that. We really haven't done anything all that impressive, but we have made a higher high here relative to this high, and this high here is higher than this high here. So the longer this data set can stay in the box and the more it can take on a look like this or a look like this, the higher the probability that good things will continue to happen. This data set doesn't tell us the low is in, it tells us we should be open to the low being in. S&P 500 up-down volume. This is the S&P 500 down here. For the most part, it's been going sideways since September of last year. Price is down here. Notice where the indicator was. Price isn't that much higher in the present day. And look how much better this data set looks walking forward, all this white space down here. And from a psychology perspective, that could be your left shoulder, that could be your right shoulder, and this could be a head. And this looks, thus far, discernibly different than anything that we've seen going back to this point here. Another positive divergence between breadth up here and the NYSE composite on the bottom. NYSE advanced decline line looks better than anything that we've seen looking backwards into Q4 of last year. It's 2009 here. All things being equal, we'd prefer to see this indicator come off the lower Bollinger Band and recapture the center line. S&P 500 down here, trying to take on that look in the present day. Volume-related charts can be subject to some post-close settling. Having said that, this looks more like this here than really anything that we've seen in here. You can pause your video player and take a closer look here. This is a breadth-related indicator. This is the year 2000. This is 2003. You can see during the dot-com bust bear market, for the most part, it didn't fire or give any signals. And for the worst part of the financial crisis in here, it didn't fire any positive signals either. Going back to the year 2000, it's been helpful, and it's recently fired in 2023. Similar situation here. We've got improvement, and improvement that's been helpful in the past. Some of these signals have not fired yet, so we'll continue to monitor them. Like to see a little more here. And the moral of the story here is this is tied to the 20-day, the 50-day. This is the 150 and the 200. Looks good, looks good. Like to see some improvement here and some improvement here going forward. Same stats look a little bit better for the broader NYSE composite. And similar to the S&P 500, the NASDAQ 100 have some work to do in these areas here. We've said in recent weeks that we'd like to see this indicator too get into the green box. We're in the green box. The longer we stay there and the higher we get, the more meaningful it becomes. You can find a little bit more about this chart on our Twitter feed at Shivako Capital. But typically when we see the ratio of investment-grade corporate bonds to treasuries, intermediate-term treasuries, IEF, retake that 30-week moving average after being below it for some time, typically, after that, good things happened in the stock market. Top of the screen, 2 bullet points from last week's video. You may remember we said we wanted to see a weekly close on the S&P 500 above 4072. Had that intraday, we got as high as 4094 on Friday, January 27th. But we had a weak close. We closed at 4070, and we're unable to get above this level here. We stalled here in late November, early December, and in a similar area in mid-December of last year. And there's a gap here going all the way back to September. So the moral of the story is, on a daily chart or on a daily basis, daily closing basis, we'd like to see the S&P 500 close above 4084, a level that has had trouble clearing in recent weeks. And we're getting close to this quote-unquote ideal setup. Of course, there's no ideal setup in the markets. It just speaks to a more favorable risk-reward profile, with the emphasis being on risk is still part of the equation. This is our 30-week moving average on the S&P 500 turning up here. This is as of Thursday's close on January 26th. We'd like to see the S&P 500 make a higher close here above 4072. Very, very close, but we have not done that yet. We have seen some incremental steps in the right direction. Resistance here, resistance here, resistance here, resistance here, and we were able to close above this line this week. And if we look at the 8-day, the 15-day, the 18-day, and the 21-day moving average and remove price, the moving averages were also able to break that downward sloping trend line that goes back to early 2022. Now, this is the SPY version of the S&P 500. These are some more hurdles that we'd like to see cleared. And for the most part, horizontal lines tend to be more important than diagonal or manually drawn trend lines. This is the close on January 27th. We still haven't closed above that manually drawn trend line, and we'd like to see these areas taken out here as well. That may happen, it just hasn't happened yet. From a risk management perspective, as long as the S&P 500 can stay above 3,900, it's relatively easy to remain patient with long positions. If we break that level here, which would be the January lows, the more important level is this cluster down here, which would be the December lows. So while the S&P 500 still doesn't have a clear breakout, it's definitely made some progress. There was a battle that took place down here for quite some time. That was won by the bulls. And thus far, we've consolidated above the colored lines, which are based on volume. The December low in the S&P 500 also coincides with this 3810 level here. That's based on the COVID low and the COVID high. So the moral of the story here is, the longer we stay above these colored lines, the more confident we can be that this rally attempt off of the October low is still in pretty good shape. If we move into this area here, the longer we stay there, the more concerned we would become. We have similar charts for every position we own, and we have them on multiple time frames. And your market leaders, such as RSP, so RSP, the equal weight S&P 500, is stronger than the S&P 500. It's cleared really all of the hurdles that it needs to clear relative to the rally attempt. That doesn't mean it's going to stay above these levels, but right now, this is a good look. If you're a bull, you'd like to stay above these levels here. This is a daily chart. This is the COVID low. This is the COVID high. So we've made a lot of progress in here. If we looked at a similar chart for the market laggards like tech, growth, and the S&P 500, they still have potential resistance above price, and they still have more work to do. And it may be that they're catching up and the leaders will take a break. So as of the close on January 27th, we still have constructive looks. In this segment, we'll focus on U.S. markets, and then in the next segment, we will shift to foreign markets. This is a NASDAQ composite relative to the S&P 500. Has some nice momentum here, but for now, it's still in a relative downtrend. This is during the session on Friday, January 27th. This band between this point and this point is that important volume by price band that we've been monitoring, and that's based on volume by price on the way up off of the COVID low. You can see there's been a battle in that area for quite some time. During Friday's session, we were above it. We were also able to poke above this downward sloping trend line and exceed this closing high here, at least intraday. This is the closing high in late November, early December. Bottom line, on a lot of these charts, this is a short-term breakout attempt. The attempt is ongoing. The longer you stay above, the more relevant it becomes. It's also relevant if we see failed breakout looks. The longer you have a failed breakout look, the more concerning it would become. A similar and encouraging look or breakout attempt here on the high-low close NASDAQ chart. This is a very, very important area in here, and during Friday's session, we were above that area. In last week's video, we mentioned that numerous indices around the globe have potential weekly resistance on their cloud charts. So this is the Dow Jones Composite Average Weekly. This represents your area of potential resistance. During Friday's session, we were above it, but that's not a confident look yet. We really need to get out here. It's not uncommon to see something like this during a bear market and then see the rally fail. We're still seeing an encouraging bottoming type look here in corporate bonds. Based on the Dow Jones U.S. Home Construction Index, it's not likely that we're on the front end of a gigantic bubble bursting similar to what happened between 2005 and 2008 down here. This index peaks 2 years before the S&P 500 peaks in October of 2007. And look how weak it is in here about a year into the bear market. It's below a downward sloping 200-week moving average. And this is indicative of an economy that's in very rough shape down here. It's not really what we have at all in 2023. In fact, ITB, the home construction ETF, has been basing down here on the daily chart for several months. Have a nice W-type formation and a bullish breakout right now. that's holding above this line here. You can see the 200-day moving average in red is trying to turn back up. And if we compare this look down here and compare it to what we have in the present day looks a lot better. The index is above an upward sloping 200-week in red and seems to be making a stand near a logical area. This really doesn't look anything like this. The odds of a sustainable rally would improve tremendously if charts like this can move away from the weekly cloud. Now, here are our bullish signals. Price moves above the cloud. Right now, we're above the cloud. Cloud turns from red to green. Red to green. We have that too. Price moves above the baseline. That's this red line here. We're above the baseline. And the conversion line in blue moves above the baseline. So we're checking all of these boxes here. Incremental improvement, still have some work to do. During Friday's session, NASDAQ 100 still in a relative downtrend versus the S&P 500. It's a nice momentum look down here telling us to be open to a break of this downward sloping trend line. Trying to make a stand near a very, very important area. This is the upward sloping 200-week here in blue. This is the downward sloping weekly trend line. And you can see we are sitting right now in a very, very important bull bear area. NYSE Composite during Friday's session, another breakout attempt here. The fact that we're above these lines or above this line intraday or even at the close, that's really irrelevant. It's still a breakout attempt that's occurring. We'll learn something either way here. Again, during Friday's session, this is back here in January of 2022. You can see we look better, really, than anything that we've seen in the rearview mirror here. In the process of trying to clear some important levels in here. And remember, we've said before, this is not an encouraging look here in 2008. This is not an encouraging look in here in the dot-com bust bear market. But if we zoomed in on this, price now is above both blue and red. It would also be very, very encouraging and constructive if stochastic here could close above the center line or the 50 level at the end of the month. This is 2009 right here, so you move from here to here. This is 2003, you move from here to here. We've been down that low and we're trying to get back to the same level, but we would have to hold that into month end. You zoomed in on this, that's a left shoulder, that's a head, that's a right shoulder. This is Thursday's close. We're above the 200-day in red, above the 50-day in blue. This is the COVID low, so this A to B move up here. In January of 2022, during the bear market, we came back somewhere between the 50% retracement of this A to B move and the 38.2% retracement. Right now, we're above both the 50 and the 38.2. Very, very important area and not a bad look that we have currently. The longer we stay above, the more relevant it becomes. Monthly, right now we're above the 10-month and the 40-month. It's that zoomed in look we just showed. Here's a left shoulder, here's a head, here's a right shoulder trying to make a stand in an upward sloping 40-month. Covered this chart many times. We'd like to see the weekly RSI clear this level, and hold it. During the session on Friday, we were slightly above at 55.22. Really like to see RSI move out into this area here. It's the 30-week moving average in blue. This is the retest and the low in 2003. This is the major low in the S&P 500 in 2009. All of this simply speaks to odds. Chart on the right side is dated January 6th, and the present day we're up here. S&P 500 weekly, this is an improving momentum look here. Made a stand here near the 50-month. Made a stand here in 2016 near the 50-month. Stand here Christmas Eve 2018. This is the COVID low. Thus far, we're still trying to make a stand in that general area. If you're a stock market bear, you want it to morph into a look like this. S&P 500 equal weight has been stronger than the S&P 500 standard weight, doing some nice things here. This is the 200-day, this is the 50-day, the downward sloping trend line. Longer we can stay in the white space, the more meaningful it becomes. This is the 5, 7, and 10-day moving averages for the VIX. If you're a stock market bull, that's not a bad look. These are weekly closes for the VIX. This is January of 2022. This is Friday, January 27th, intraday. World Technology Index, Thursday's close, trying to make a stand at a logical level. This is the upward sloping 200-week in red. NYSE weekly cloud, longer above, the more relevant it becomes. This is IEI relative to LQD. This is what economic fear looks like in early 2022. This is what economic fear looks like after the S&P 500 peaked in mid-August of last year. This is what the same chart looks like after Thursday's close. This is JNK divided by BIL. This is your fear look here in early 2022. It's probably fair to say that we look a little bit different over here in early 2023. Covered this chart. This is October 28th. We covered this in a weekly video. This is possible cloud resistance for VTV. You can see for the most part we blew right through that, and we've been consolidating above it. VTV hasn't made a lot of progress in recent weeks, but from a trend perspective, this is still a good-looking weekly cloud. Still have a positive divergence between leveraged loans and the S&P 500. This is Thursday's close. Gold unequivocally and unquestionably is doing some good things. However, it's still clearly in a longer-term downtrend versus the S&P 500 index. Pretty easy to see. This is January of 2022. This is high-yield bonds, HYG in isolation. Pretty easy to see that this looks better, really, than anything that we've seen in the rearview mirror. Risk-on oriented biotech, IBB. This is a nice-looking, maybe left shoulder, head, long right shoulder. You can even say this is a cup and handle formation. The bottom line is it's been moving sideways, consolidating, basing, and now it's trying to break out. Hasn't done so convincingly yet, but it is above the moving average cluster now, and this looks quite a bit better here than it did here relative to the trends. You might think this is a headline from this week. Recession risks are uncomfortably high and moving higher. It's a headline from 307 calendar days ago, or March of 2022. Moral of the story, this is why we trade the chart in front of us. If the data sets, the economic data sets, start to deteriorate, then that would be concerning. As we've shown in previous videos, right now, the data that's typically used to call a recession, frankly, looks incredibly strong still. That may be about to change, but it hasn't changed yet. We have to ask ourselves, if the market thought that earnings and the economy were about to tank, and the Fed would most likely be moving closer to pivoting, or maybe even closer to lowering rates because the economy is about to get so bad, do we really think that this ratio would look like this? This is as of Thursday's close. IEF underperforming the equal weight S&P 500 by 2.03%. Weekly MACD below zero. Ratio below a now downward sloping 30-week. Is it possible that this is about to change? Absolutely, positively, yes, and it may change very, very soon, but it hasn't changed yet. If we want to see an example of what the bears want to see, here's a nice look and reminder of what economic fear would look like, maximum fear, on this chart. And relative to the COVID crash, we look quite a bit different in the present day. IEF relative to SPY, using similar logic, right now we can check a lot of bearish boxes for this ratio. Mid caps during Friday's session. Small caps during Friday's session. NASDAQ 100 weekly is a large chart. Nice momentum look here. Trying to make a stand at the 200, 225, and 250 week moving averages. QQQ Thursday's close with an improving look here. Equal weight S&P 500 during Friday's session, longer above, the more meaningful it becomes. You'll notice if we compare this chart to a chart of SPY, we've exceeded levels on the equal weight that we have not yet exceeded on the standard weight chart. Speaks to market leadership. Weekly cloud for RSP during Friday's session. Bullish odds increase when the lagging span green is above price. Check. Price is above red. We can check it. Blue above red. Blue above red. We can check it. Price above the cloud. Check it. In fact, we've been above it. Came back, and this week printed a higher high. Don't have the cloud shifting yet from red to green, but you can see it is getting closer potentially. If you're a stock market bear, you would love to see RSP get back to the other side of the cloud, and that would be concerning. Equal weight S&P 500 RSP doing some nice things. We closed at 150.80, or above this level here. Longer above, the more relevant it becomes. Weekly MACD down here, above zero for the first time in quite some time. It's a risk-off look. This is a risk-on look. This is the look in the present day. Very similar logic here with an improving look in the lower right-hand corner of your screen. SCHM in isolation. Your market history, the S&P 500 made a major low in February of 2016. Compare the look here, SJNK, to the look in the present day. Here's risk off during 2022. Here's risk off during COVID. Here's the present day. 200-week moving average, SP low volatility divided by RSP, or the equal weight S&P 500 index. We know the S&P 500 bottomed in March of 2020. This would be the COVID low. This move here, this look here, and this look here, you can compare to the present day, or January 26th in this case. This is a weekly chart. Similar concepts here on the daily. This is the 200-day moving average. This is risk off in here. Polar opposite in the present day. This looks more similar to this over here, other side of the COVID low, than this here. December of last year was not particularly kind to stocks. Mid-month, we had a breakout. SP low volatility relative to SPY in here. Almost the binary opposite now. Now it looks like a failed breakout with the ratio below the 200-week moving average for the first time in a very long time. SPY divided by SP low volatility, what once acted as resistance, may now act as support. Similar to the RSP chart we covered, XLF here trying to clear an important level. Weekly MACD above zero. Tech is still a laggard, still in a relative downtrend, but if you're a stock market bull, regardless of where you're invested, you want to see the NASDAQ, you want to see growth stocks, and you want to see tech stocks bottom and hold their recent lows. Here's a breakout for XLP divided by SPY in December. Looks quite a bit different in the present day here. It's the weekly version of XLP divided by SPY that we marked up on December 30th and said, if you want to keep an open mind about better things happening, this does look similar to this potentially. And this, if we look at the same chart today, now it looks a little bit like this and or this. And this is what happened next in the S&P 500, and this is what happened next in the S&P 500. Doesn't predict anything, it just speaks to odds. We said early in the video that the NASDAQ made a new closing low for the bear market in late December. So did this ratio. Didn't look particularly good, and we covered it. Look at the improvement that we've seen since then. It's a 20-day moving average here in blue of consumer discretionary. New highs minus new lows %. This is a bullish or positive divergence with the S&P 500. Covered this in January. This one's dated January 6th. Said I had to keep an open mind that this looks similar to the COVID low in the S&P 500. If we fast forward to Friday, January 27th at 2:11 p.m. Eastern Time, it still looks similar to the COVID low. Now let's shift gears to foreign markets. In last week's video, we covered this chart in detail and said the present day looks a lot more like these constructive periods relative to the financial crisis or risk-off look. This week, VEU outperformed IEF by over 1%, meaning for the most part, everything that we said last week still applies this week, and in fact, the chart looks even better at the end of this week. So monthly German DAX, this is the dot-com bust bear market, this is the financial crisis, this is the same moving average and price in the present day on January 26th. It's a weekly chart of the dollar, which is a big factor relative to foreign and U.S. performance. Just as many stock charts on a weekly basis are running up against potential weekly cloud resistance. The U.S. dollar has potential weekly cloud support. It's also near a 50% retracement. Not predicting anything, just something to be aware of. Still looks good. Bloomberg article, January 24th, still have a constructive look relative to the long-term outlook. EFA Thursday of this week can check a lot of these boxes. EFA monthly, this is the look we want to avoid, price below blue and red. We've recaptured blue and red. The longer that remains, the more encouraging it becomes. This is the bottoming process look in 2009. Bottoming process, the COVID low. Here's the look in the present day. And maybe more importantly, compare this look here to this look here during the financial crisis. Price relative to the 30-week looks better than anything we've seen. Weekly momentum, much improved. Concerning look here, concerning look last year, an improved look here on the monthly chart. Compare this with this list. The longer we stay above, the more relevant it becomes. This is potential resistance in here. A lot of these foreign ETFs have moved a long way. It's possible even if good things happen, they need to retrace a little bit. Just as risk appetite has improved significantly since the Nasdaq made that closing low on December 28th, nothing says it can't flip back the other way. The game plan for us is to manage risk with a defensive bias. What does that mean? That means we always know what levels would cause us to pay closer attention and to potentially take some action. If we can hold those levels and we own the positions and they move in this direction, then the rest of it pretty much takes care of itself. There's a wide variety of instruments, asset classes, and indexes around the globe that are trying to clear important bull-bear hurdles. If they're able to do that successfully, we'll learn something. If they're not able to hold those levels and we see failed breakouts, we'll also learn something. The fact that risk appetite has improved over the past several weeks doesn't negate any of these concerns. We still have to respect the downside argument and the bearish case. There's a little more about this chart on our Twitter feed, but for the most part, the economic data still just doesn't look that bad. All of these bullet points that we covered last week still apply, including 4072. We have not checked this box yet. The Fed under Powell likes to telegraph moves. For the most part, we have a 25 basis point move coming this week. It'll be easier to take some additional cash off the sidelines if we can clear these levels. And the Fed has also telegraphed, in terms of their base case, they're getting much closer to a pause. The improvements that we've seen tell us to keep an open mind about better than expected outcomes. If we don't see better than expected outcomes, we can handle that by properly trading the charts in front of us. And we all know the only way that we can do that effectively is to head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.